I am AI Avatar of CA Ratan Mundra. The International Financial Services Centres Authority, through the Managing General Agents Regulations 2026, has introduced a dedicated regulatory framework for managing general agents operating from IFSCs in India. These regulations became effective from the 8th of June 2026 and replaced the earlier NGA provisions that were part of the Insurance Business Registration Regulations 2021. This change reflects the growing importance of delegated underwriting and insurance distribution models in international markets. The new framework establishes clear requirements relating to registration, governance, capital, operations, compliance, and risk management. By creating a standalone regulatory regime, IFSCA aims to provide greater regulatory certainty, attract global insurers, and enhance confidence among investors and insurance market participants. The regulations also align IFSC insurance activities with global best practices and strengthen India's position as a global insurance and reinsurance hub. A managing general agent, commonly referred to as an MGA, is a specialized insurance intermediary that receives delegated authority from a foreign insurer. Unlike traditional brokers who mainly facilitate insurance placement, an MGA can perform significant operational functions on behalf of an insurer. These functions may include soliciting business, underwriting risks, issuing insurance policies, processing claims, and even settling claims within approved limits. This delegated authority allows insurers to expand into new markets efficiently while maintaining oversight of business operations. The regulations formally recognize NGAs as a distinct category of insurance intermediary with enhanced responsibilities. This recognition is important because it provides legal clarity regarding the scope of activities that MGAs can undertake and establishes accountability mechanisms for all parties involved. One of the most significant developments under the 2026 regulations is the creation of a standalone MGA framework. Earlier, NGA-related provisions existed only as a small component within broader insurance registration regulations. The new framework introduces detailed definitions for critical concepts such as managing general agent, binding authority agreement, fiduciary account, and minimum qualified personnel. This level of regulatory detail minimizes interpretation disputes and provides certainty to businesses planning to operate in IFSC. The regulations also establish structured compliance requirements and supervisory expectations. By formally recognizing the MGA business model as an independent segment of the insurance industry, IFSCA has created a more robust environment for global insurance players seeking to establish operations in India's international financial services ecosystem. The regulations establish stringent eligibility requirements to ensure that only credible and qualified entities enter the IFSC insurance market. Every MGA applicant must have a written arrangement with at least one foreign insurer. The applicant should demonstrate relevant experience in underwriting, claims management, or insurance operations. Additionally, the home jurisdiction of the applicant must comply with Financial Action Task Force standards and maintain a double taxation avoidance agreement with India. Foreign insurers partnering with MGAs must possess a minimum net worth of $100 million and maintain an acceptable international credit rating. These requirements create a strong quality filter and ensure that only financially stable and professionally managed organizations participate in the IFSC insurance ecosystem. Financial strength is a key pillar of the MGA framework. Every MGA must maintain a minimum capital of $500,000. In addition, net worth must be maintained at either $250,000 or 50% of paid up capital, whichever is higher. Any shortfall must be rectified immediately and reported to the authority within 15 days. Before commencing operations, an MGA must also maintain a security deposit with an IFSC banking unit. This deposit consists of $10,000 plus 10% of the minimum capital requirement. These financial safeguards are designed to enhance operational stability, protect policyholders, and ensure that MGAs have adequate resources to support their delegated responsibilities. One of the most important operational requirements under the new regulations is the establishment of fiduciary accounts. Premium collections and claim settlement funds must be maintained separately from the NGA's operational accounts. These funds cannot be mixed with business revenues, salaries, rent expenses, or any other corporate expenditures. The regulations further provide that such funds cannot be attached by creditors and do not form part of the MGA's assets during insolvency proceedings. This framework ensures that policyholder money remains protected at all times. For finance and treasury teams, this requirement will necessitate significant changes in accounting systems, fund management practices, and internal control procedures to ensure full regulatory compliance. The regulations place strong emphasis on governance and risk management. Every MGA is required to maintain board-approved underwriting policies, conflict of interest frameworks, internal control systems, and audit mechanisms. In addition, the regulations mandate continuous professional indemnity insurance coverage. This insurance must protect against professional negligence, errors, omissions, and cyber-related liabilities. Since MGAs exercise delegated authority on behalf of insurers, operational mistakes can have significant financial and reputational consequences. Therefore, governance is no longer optional but a fundamental regulatory requirement. Many MGA operators may need to establish governance structures comparable to those used by insurance companies, ensuring transparency, accountability, and effective risk oversight across all operations. Recognizing the increasing importance of technology, the regulations require MGAs to implement robust cybersecurity and cyber resilience frameworks. Organizations must establish data protection controls, conduct security assessments, implement incident response mechanisms, and manage technology vendor risks effectively. At the same time, the regulations create significant opportunities for digital insurance innovation. MGAs may connect with insurer platforms, develop digital insurance ecosystems, use online solicitation channels, and conduct regulated telemarketing activities. This creates an enabling environment for insurtech companies seeking to serve international markets from IFSC. As insurance distribution becomes increasingly digital, cybersecurity will become a board-level priority and a critical component of regulatory compliance. The regulations introduce comprehensive reporting and oversight requirements. MGAs must submit audited financial statements, capital adequacy certifications, net worth confirmations, fund segregation reports, related party disclosures, and operational performance information. Foreign insurers delegating authority to NGAs are also required to conduct annual audits and periodic on-site reviews. Importantly, the insurer remains accountable even after delegation of authority. The authority has been granted extensive enforcement powers to address violations relating to capital requirements, governance failures, AML deficiencies, claims management issues, or false disclosures. Regulatory actions may include inspections, investigations, suspension of registration, or complete cancellation of authorization. As a result, compliance management becomes essential for business continuity. The IFSCA Managing General Agents Regulations 2026 represent a transformational step for the insurance sector within IFSC. Organizations planning MGA operations should focus immediately on capital planning, drafting robust binding authority agreements, establishing fiduciary accounts, securing professional indemnity insurance, appointing qualified personnel, and implementing governance and cybersecurity frameworks. While the compliance burden is more extensive than before, the regulations also create significant opportunities for global insurers, MGAs, reinsurers, and insurtech firms. The framework balances innovation with policyholder protection and regulatory oversight. Organizations that invest early in governance, technology, and compliance infrastructure will be best positioned to leverage the growth opportunities emerging within India's evolving international insurance marketplace and contribute to the continued development of IFSC as a global insurance hub. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence. A pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.